The stock market is going out of control. Is it overvalued? Is it overbought? In this video, we are going to look at what the smart money is doing and what the dumb money is doing so we can pay attention. You came here for the truth, so let me unveil that for you. We are going to go in depth into this. I'm going to show you for some different angles to give you an idea of what's happening right now today. It's actually quite interesting. Let me start right here. You know that Jerome Powell is always there to save the day, and he says, quote, "I want to assure the American people that we are fully committed to returning inflation to our 2% goal." Thank you very much, Jerome Powell. I'm sure Americans everywhere are so pleased that you're doing a great job of bringing inflation down. Yes, sure is. Stocks enter belief phase with most investors converted to bulls. What it means going forward: this was the month when the crowd shifted decisively from fighting the bull to embracing it. Of course, you look at it, what carried this market? Ultimately, AI stocks number one. And then, as they say here, the anti-obesity trends, meaning those drug companies that sold people on the Ozempics and all this stuff. And they did extremely well. And so and the articles were funny because they were even saying, look, the more people that take Ozempic, the better the economy is going to be. I mean, you could make an article about anything. It was probably written by AI. So, anyway, that's what we're seeing right now. We've got to look at the trends. And so when you see where the money is moving to, you can start to gauge what's happening. And as we see it right here, dumb money is almost back to even, making the same mistakes. Usually what happens is the retail investors find themselves all piling into the exact same trade. They go in for way too long. They stay in right all the way to the peak and all the way past the peak and down. Do you remember Bre-X? Are you aware of that? There was the money, that movie with Matthew McConaughey. I think it was called Gold. It was they didn't say it, but that was about Bre-X. And what happened there? Well, I know people that didn't know anything, never invested in their entire life. And yet they were getting into Bre-X. And that's a very extreme example of investing gone wrong. We shouldn't chase these trends. We should simply look at it and sit there carefully and not get too antsy and not get too itchy about trying to get into a stock. We should make the right decisions based on our goals. What are your goals? That's the first question you should be asking before you ever pull the trigger. Am I going for wealth preservation? Am I going for maximum appreciation? Do I want cash flow? So on and so forth. If you haven't asked those questions before you bought the stock, before you bought that asset, something's wrong. Okay, because you were influenced from the outside. Okay, so you got to know that. As long as you know that. And the second thing is, what is your exit strategy? When will you sell? You got to know. Now that might change after a week. That might change after a year. But you've got to know as of the moment when you're buying, what is my exit strategy? Most people have not determined these two things. And of course, they're getting their advice from those on YouTube. Percent of the Russell 2000 firms with negative earnings. This is not good. Okay. You want to see a lot of different stocks, not every stock, but a lot of stocks that are making money, that are generally doing well, and that they are not just like as a company, their operation, but their stock is generally moving in the same direction as the market, which you hope would be up. But we're not seeing that now, at least in the case of the Russell 2000. I pulled this up, Google Trends. Google Trends gives you a little bit of insight as what retail investors are doing. And they're looking at call options more than this is the past 12 months. They have never searched this much for the keywords call options in the last 12 months. So the retail investors is going to get into options. And as I've said before, there are a lot of these guys on YouTube who will teach you about options trading courses. And you'll take the course and you're not only going to give money to the market, you're going to give money to that guy who sold that course. You're not getting any money. Okay, the vast majority of people who do options over a longer period of time will lose. The pros, okay, the guy who taught me, not even him, after doing so for, let's say, 14 years of absolutely like 5 days a week trading and 2 days a week, at least 1 to 2 days a week on studying, he doesn't even do options anymore. All right, because it's better to use a large amount of money and put that into the market in a single trade that might move, 0.5%, and that would make you have lower risk than using options. It's not good. Okay, the risk is so high of losing your entire investment. It's just not. It's not wise for the vast majority of people. Not to mention the fact that you're probably going to incur higher taxes. Depends on where you live. Okay, Europe's narrow rally is recent compared with the US. So this is just showing us at the top, you're seeing Europe, at the bottom, S&P 500. And looking at this, come on. There have been some European stocks that have been doing well, but overall, the US has performed much better over this period of time. There are a few in there, though, in Europe that have been really carrying the market. You would want to talk bad breath. Wow. Yeah. Internal RSI measure for the S&P 500 has never been higher. So this is the percentage of stocks with an RSI, that's a relative strength index, greater than 70, reached a series high in December. And so what this means is basically it's an oscillator, okay? It tells us in relative terms, relative to recent past, or depending on the time frame you're looking at, how overbought or oversold something is. And there's different ways to look at it or whatever, but the way they're doing it here is basically over 70 means overbought, all right? And so there it is. Never seen it this high before. Never. So what does that tell you? It means that stocks are generally overbought right now. And that doesn't mean that it goes crashing tomorrow. That means that it's very difficult to push higher. And that means that there's increasing probability that the market moves down. Doesn't have to move a lot down, but the market moves down. The probability increases the market moving down rather than moving up. That's all it is. Increasing probabilities. All right. Stocks are relatively overbought, but not yet at extreme. So when we look at a different way in the standard deviations, you can see that, yes, we are in that overbought territory. It's not super extreme. We've seen that before, like 2020. Everybody's just jumping on the bandwagon. Yeah, we're not quite there yet in that respect. You have the technical overbought/sold composite. This is from Real Investment Advice. And, their website, they have great indicators. And you can just see here for yourself. Okay, going to extreme heights, 96. Out of a scale from 0 to 100. So pretty high there. And this is one bank that has begun to fail. So the problems are there underlying all of this. Many stocks punished, but others have been doing very well. So we got to watch out where we put our money and what kind of companies are exposed to these companies that are not doing so well. NYCB extends its route after the latest round of credit downgrades. So it's just one stock, and by the time you're watching this video, who knows? But just be very careful about the exposure to these high interest rates, knowing that even if they start cutting interest rates, it's still going to be high. So you don't want to be exposed to that. All right. And then we talk about Warren Buffett. So we can call that the smart money, maybe, perhaps. Well, he's talking about Coca-Cola, talking about these very big companies. And I want to make this very clear. So shout outs to the Finance Friday crew. This is something that I want you guys to know, okay? So he's saying Berkshire is not big on newcomers. And that's part of the joke, right? Because he might miss a lot of opportunities in that case. These are Berkshire Hathaway's longest held positions. They're also the second and third largest positions in the portfolio behind Apple's gargantuan percentage. American Express is 8.9% of the total. Coca-Cola is 6.6% of the total. So those are some of the biggest companies that Buffett has. Now, why? These companies have a core business that has been incredibly successful more than a century. They've tried to branch into new side hustles that haven't worked out, but their main business has flourished. They travel, quote, travel, as their products have worked themselves across the globe. Their names have become synonymous with their core business, building strong, resilient brands. Both of them market products and services that are always in demand, timeless essentials of our world. Credit cards, and of course, Coca-Cola doesn't just make Coke products, they make all kinds of different products. But no matter where you go, you look in countries that are sanctioned from head to toe, they have Coca-Cola products. Can you believe this? You go to any country in the world, you will be able to order Coca-Cola. All right? So that's what he's saying. It's how far and widespread they are. In the case of Apple, you got to understand this. This is an American company, right? They might manufacture a lot in China, but they might have, sales in Australia. They might have sales in different countries of Africa. They might have all these different things, right? It's not just one place, like where the company's headquarters is or where the vast majority of their, original consumers were. You got to know that they start opening up to different markets, and each one of those is a potential sale, potential revenue, and then the services that come along with it. Of course, if you have a consumer, let's just say with the Coca-Cola, they're not drinking Coca-Cola one time. They're probably going to buy it each and every single day. So keep that in mind, right? You want those returning customers, the residual income. All right, if you want to know more, all the details of the financial system, very simply explained in Compass. Compass is totally free. themoneygps.com/compass, or you just go to themoneygps.com. The link is right there, totally free, no paywall, no email to enter. You just go there, learn. It's 20 minutes, super short videos. I brought that to you so that you can not only view it for yourself, but you can share it with friends or family. And there's no links at all on that page to like the Money GPS, my YouTube, none of that. So you can feel confident sharing that with your friends and family. themoneygps.com. I hope to see you tomorrow. Take care.